This mega cap mania is pretty remarkable. Not much seems to want to stop it. You concerned about it at this point?
I mean, there's three reasons these things are up. One is people are more dovish than they were at the beginning of the year, and that drives the multiples. Two is the relative perception of safety that they have in terms of their earnings estimates. If everything's way too high, maybe they're only a little too high. And the third is AI, and all those things are real, and I think they explain the returns. I mean, in order, you mentioned up top of the hour, what's the catalyst to potentially get them lower? It's probably in order. People getting the wind that maybe the Fed's a little bit more hawkish than what's in the bips, that maybe they're not going to cut 50 bips, but maybe they're going to pause longer, or, that could probably bring the multiples in a little bit. Or if you somehow get a slowdown in earnings in July, I don't think any analyst can call builds on a 1 month out for a big company like that. There's just the problem with Apple and others is it's, A, its returns are 80% explained by macro factors, and B, it's like a 28 variable problem you're trying to isolate to one, right? So it's going to be hard to call Apple's quarter on any, kind of consistent basis.
You gave the reasons, the few reasons why you think the stocks have continued to run.
Right.
You use the word to explain why they're up. Do those same reasons, quote unquote, explain the valuation, or is that an area that you would take issue with?
Listen, I think every stock, and we've been, as talking about this for a while, it's going to be in one of three buckets. It's either going to be benefiting from AI, impregnable to AI, or destroyed by AI. That's it. And so I think the wrong thing going to be do within the market is going to say, I want to buy the cheaper stuff because and short the expensive stuff. Because in essence, what you're going to be doing is longing companies that are vulnerable to destruction and shorting stuff that's either impregnable or a beneficiary. So I think maybe within each of the buckets, you can try to find longs and shorts. But I don't think you want to say, oh, I don't like these stocks because they're expensive when they're benefiting or impregnable to a major trend that's going to last for many years.
Yeah, I do want to ask you about the debt ceiling and the impact on how the market may react either way.
Sure.
Before I do that, there were some new headlines coming out of Washington, D.C., our nation's capital. Kayla Tausche is down there ahead of that 5:30 meeting today between the president and the speaker. Kayla?
Well, Scott, House Speaker Kevin McCarthy spoke to reporters just last hour following a meeting between his deputies and White House negotiators that wrapped earlier today ahead of the meeting between the two principals that will happen here at the White House. McCarthy told reporters that he thinks it's possible to get a deal as soon as tonight or later on this week, but said that a deal would have to happen this week to pass the House and then be taken up by the Senate after Memorial Day next week before that June 1st deadline. Asked to reiterate that he believes it's possible to get a deal by the June 1st deadline, he said it's possible. Now, he also said that in order for a deal to be made, decisions have to be made. Now, certainly there have been high-level decisions that have not been made thus far in the talks, notably how much to cut federal spending by and for how long. In order to get any deal on the details of federal spending, the two sides will need to agree on some sort of top-line spending level and then get down into the details after that. We're not there yet, Scott, and that is something that we're watching for later today. Any progress in the right direction from the two principals will certainly be a move in the right direction.
Yep,
Scott?
Certainly will. Kayla, thank you. A little more than 2 hours away now at the White House with that big meeting. Kayla Tausche, as you see right there at the White House. All right, so let's game this out. How are you thinking about this? As some suggest that it's not so cut and dry, that it could be a sell on the news. Well, I've heard that. Do you think there's a risk of that in any way?
Well, in any way, sure. But, I mean, the last 10 times, the right thing to do was not worry about it, because if you really think about it, there's only two possibilities. One, massive, immediate austerity, or two, raise it. So which one do you think's higher likelihood, right? So the pattern is...
The deal's going to happen.
Right.
Obviously.
So historically what's
But it's going to get potentially messy in the interim.
Every time. Historically what's happened is that this market goes up on the resolution more than it went down being fearful about it. So I think that's still the base case. But your question is possible, depending on the messiness that unfolds. But I would say, not on my radar screen as a top 5 issue I'm worried about right now, because I think there's just a one-way answer to the question, and ultimately it doesn't matter. They have to raise it.
So what about the Fed? Now, you mentioned at the outset, as we're talking about, certain things that could derail the mega cap trade being a more hawkish Fed. What about this idea being put forth of a so-called hawkish pause, where they pause in June, but they lead you to believe that they could easily go in July, or thereafter.
Yeah.
Exclusive interview today on this network. Neil Kashkari seemed to put forth with that. Jamie Dimon today at the J.P. Morgan Investor Day said everybody should be prepared for rates to go higher from here, and which they have of late, as you know from watching yield. So how do you assess all of that?
I guess, my bias is to agree with that. I think probably what's in the price, if you look at what's in the price, it's probably more dovish than what's going to unfold. The simple logic is simply looking at unemployment and looking at CPI, and those two indicators still in absolute terms look very high. And I think the unemployment cycle is not going to unfold this cycle the way it did in the past, right? We have a shortage of low-end workers across the board in a number of industries. So I don't think the unemployment rate would normally be this low in prior cycles. So I wouldn't be surprised if you say, look, risk-reward skewed to one or the other. I think risk-reward is skewed to they're more hawkish, and that's why probably you should be a little bit more cautious. Look, we came into the year saying we're bullish and everyone else is bearish, but maybe the second half, I think we're getting now to the point where you get a little bit more worried about the market, because I think the risk-reward on the Fed is negative, and it's happening at the same time where everyone else is starting to get a little bit more bullish because they can't stand that they missed the magnitude of the rally.